Hi, I'm guessing that if you're listening to this, then one of these next three statements may describe where you're at in your property journey. It may be that you want to buy a few buy-to-let properties to supplement your pension, or perhaps you want to buy a few buy-to-let properties to supplement your current income, or perhaps you want to be a bit more aggressive than that and would like to build a portfolio of buy-to-let properties so that you can be financially free. And wherever you are on your property journey, I'm going to help you with that tonight. Now, one thing which I've learned in my 30 years in property is this. The secret to being successful in buy-to-let is buying the right properties. The secret to being successful in buy-to-let is buying the right properties. And I realise that that might sound very simple and very obvious, but the truth is that I come across a lot of investors who don't actually do that. But before I go any further, I just want to thank you for joining me tonight. I know that you could have been doing all sorts of other things tonight, so I'm very grateful that you've tuned in to listen to me. I'm also very grateful to Arsh, who's helped me to put this webinar together and who's invited me to speak. But before we go any further, who am I? Well, my name's Peter Jones, and I'm a chartered surveyor, and I've been in property for over 30 years, all of my working life. And for the last 19 or so years, I've been assembling my own portfolio. And I started from scratch with no money of my own, and I'm now financially free, living off the passive income that produces. And property has allowed me to do some really fun stuff. When I first started back in year 2000, there was no books aimed at buy-to-let investors, and there was very little teaching, if any at all. And so I actually wrote one of the first books. I mean, it's hard to imagine now, in this day and age when we have Amazon, but there was no training. So I decided to write the book to help others. And I went on from that to write several other best-selling ebooks. And I wrote a couple of books for property secrets. And more recently, I've been writing articles for magazines and newsletters like Property Auction News. And I've been invited to be a guest blogger for Property Secrets and for Progressive Property. And just recently, I've been appointed a guest blogger for Landlord Zone. And aside from all of that, I also trade property, and I mentor people and meet some very interesting people and talk about property with them, and generally have a great time. But I'm not saying any of that to boast, because none of that is down to anything clever on my part. It's just that I was fortunate to find a system which works and which allowed me to put together the portfolio which now pays me the passive income. In fact, if you'd seen me when I first started 19 years ago, you'd have seen somebody very different. I'd just been made redundant, I had no income, and I had no savings to fall back on. But what I did find was the system, and that's really what I want to be talking to you about tonight. So who is this webinar for? Well, it's definitely for anybody who wants to get into buy-to-let and who wants to get off to the best possible start. But it's also for anybody who's already started, but who's perhaps stalled, and who is struggling to hit their financial goals and targets in property. And it's for anybody who's doing okay, but who wants to do better. It's also definitely for anybody who wants to put together a portfolio and who wants to be confident that they won't run out of money before they've finished. But just to be clear, it's not for anybody who's extremely experienced and successful and who's happy with their progress. So here's what we're going to be talking about tonight. We're going to be talking about what do you want from property, what's the right strategy to get you what you want, how do we find the right property for our strategy, how do we buy and finance our property, what can we do with our property to help us make real money, how do we refinance our property, and what do we do then? And really the ideal that we're trying to achieve in our buy-to-let investing is being able to buy the right property so that we can pull all of our money back out again and then go and buy another property. And again, we'll be looking at that in a moment. So if buy-to-let is so easy, why are so many people getting it so wrong? Well, it's a very interesting question. As I say, I do some mentoring, and over the years it's become apparent to me when I've been talking to my mentees, and actually not just my mentees, but also other investors who I meet, that although we think we know how to buy investment property, few of us actually do it very well. In fact, I met with one of my mentees just a few weeks ago, and he was telling me that he had been talking to his father-in-law, and he told his father-in-law that he was going to meet me and that we were going to talk about buy-to-let and that hopefully I was going to help him to get started. And his father-in-law said to him, well, why do you bother with all that? Why don't you just go out and buy a property? And unfortunately, that's the way that a lot of us think. Another problem which I see time after time is investors who run out of money. They get out of the blocks really, really quickly. They're very enthusiastic. They go and buy some properties, but they haven't really got a cohesive plan. And so what ultimately happens is eventually they'll run out of money and they can't buy any more properties. And they're usually well short of where they wanted to be. Another thing I see is some investors who aren't quite sure why they've bought the properties that they own, which might sound a bit harsh and a bit strange, so let me explain what I mean by that. I'll meet investors and they'll perhaps show me properties on a spreadsheet, and I'll say, well, why did you buy that one? And they'll say, well, that was for income. But when you look at the figures, you can see that the property is never going to cash flow enough in order to give them the income that they want. Or maybe they bought it for capital growth, but you know that it's in an area which isn't the best area to buy for capital growth. So after a little bit more digging, and I'll say to them, well, why did you buy that property? They'll have a very vague reason, like, oh, it was a nice house that was like my house, or it was the house down the road, so I thought it would be easy to manage, something like that. Sometimes you might come across an investor who's bought a property something like this. They might have gone down to the local estate agents and they were looking at the details in the windows and they saw a picture of a property which they liked. Perhaps it was in an area they're familiar with. Perhaps it looked like their house. Or perhaps it was the house down the street, which would be easy to manage. And so they go into the estate agent and they ask for the details and they make an appointment and they view the property and they think, you know what, I'm going to buy that property. So they make an offer, and if they're feeling very sophisticated, they may offer 5 or 10% below the asking price. And if they do a really good negotiation, they may even buy it at 5% below the asking price. And then they'll feel that they've done a really good deal. And I don't know if you can relate to that. Certainly I can, because I did that when I first started in property. And I know now from experience that that's not the best way to buy property. But the truth is that in principle anybody can go and buy a property and then can wait. And usually if you wait long enough, because the market's cyclical and because we all know that it'll go up in the end, probably eventually they will make money from it. But it'd be much better to buy with a system in mind. Unfortunately, many investors don't actually do that. They don't buy with a system in mind. Now, I'm not knocking that, because the mere fact that they've actually taken action to buy a property elevates them probably into the top 5% of the population. But sadly, good intentions don't guarantee the right results, and they certainly don't guarantee high yields or high capital growth. Now, as I say, I'm not being critical because I've been there and I've done it. I've made all the mistakes there are to make. And the system I use really came about by trial and error. And trial and error means that you get some things right and you get some things wrong. So if you've made any mistakes like this, then please don't worry. As I say, I'm not being critical. And the good news is that now's the time to review where you're at and how you do things, and perhaps going forward to change things so that you can buy in a more predetermined way. And I said earlier that the secret to being successful in buy-to-let is buying the right property. And so that's why a system is so useful, because it can keep us on track. It can make sure that we're actually buying the right properties, using the right strategies and techniques. Now, as a starting point in our property journey, or as a review point if you've already started, we need to ask ourselves, what do we want from property? Now that might sound like a strange question, so let me explain in a little more detail what I mean by that. The truth is that many property investors I meet and mentor don't often have a clear idea at the start of what they're actually trying to achieve. They have a vague idea that they'd like to be successful in property, or that they'd like an income in property, or that they'd like to own a few properties so they can have some capital growth, or maybe they want to own a few so that they know they've got something to look forward to in the future. But it's all a bit vague and wishy-washy. And the problem is, if you're not absolutely clear on what you want to achieve from property, then really buying any old property will do, which, as we've seen, isn't really the way forward. In my opinion, an investor needs to know exactly what they're trying to achieve and why, which, if you think about it, isn't unreasonable. We're talking about spending very large sums of money, and we shouldn't be doing this on a whim. So we need to know exactly what we're trying to achieve, and then to express this as clear, focused, written goals. And even better is if we can actually stick some financial figures on as to what we're trying to achieve, so that we're very, very clear and precise in that. We also need to be very realistic in our time frames. I meet investors who want to start earning a passive income from tomorrow, but with the best will in the world, that's probably not going to happen. It takes time to build a portfolio and to build an income. But because it doesn't happen quickly, they can get very discouraged and give up far too soon. I don't know if you've heard the expression, and I can't remember it verbatim, but it goes something like, you'll probably achieve less in a year than you hope to, but you can achieve more in 5 years than you can imagine. Well, certainly that's true in property, and I'm not saying that you should work to a 5-year timescale, but just think about this. Supposing you did give yourself 5 years to create a passive income. Well, in year 1, you might just do 1 deal, which doesn't sound very much, but just bear with me. What if in year 2 you then do perhaps 2 deals, and in year 3 you might do 3 or 4 deals, and in year 4 you might do 4 or 5 deals? Well, with the market recovering, with the equity in your small portfolio building, with the income coming in, it might be that in year 5 you can buy 8, 9, 10, 11, 12 properties. And just think what you'll have achieved over that 5-year period. And that's all starting with just 1 property in your first year. Now, if you focused on that first year on the fact that you only bought 1 property, you might consider that a failure. But you've actually sown the seeds for future success. And you probably wouldn't be able to envisage what you can achieve when you walk out of the estate agent that very first Saturday morning. You might have a handful of property details, and you know that most of the details are of properties that are totally unsuitable for what you need. And it may seem that, the dream of owning a passive portfolio which pays passive income is just so hard to imagine it coming to reality and being a reality. But it can happen. The point is, you just don't need to do that many deals. You just need to be consistent and do a few every year. So what's the right strategy to get what you want? Well, once we've decided exactly what it is we want from property, we can then decide on the right strategy. And when you think about it, there's only 3 basic strategies in property, in my opinion. That's buy and hold for income, buy and hold for equity, and buy and sell for cash. I'll just repeat that. Buy and hold for income, buy and hold for equity, and buy and sell for cash. And by equity, in this context, what I mean is the difference between the value of the property and the amount of any mortgage on the property. So that difference, that little bit of chunk of top-end value, that's your wealth. That's the bit of value that belongs to you. So when you know what you're trying to achieve, then you'll naturally be able to choose the strategy that's going to work best for you. So, for example, if your principal goal is to generate income from property, then your principal strategy is more than likely going to be buy and hold for income. And this will require you to buy properties cheaply so that you have a smaller mortgage, so you have smaller monthly outgoings, so you keep more of the rent as income. If, on the other hand, your future goal is equity because you want a chunk of capital, perhaps in 15 years' time when you retire, then it may be that your principal goal is going to be buy and hold for equity. And so you'll be buying properties which have a realistic chance and a genuine expectation of significant price growth, of significant value growth. And you may choose to buy properties in a particular area. For example, at the moment, London and the South East is booming, but whether that will continue, we don't know. You may look more generally. You may go to areas which is perhaps a regeneration area, or an area marked for new infrastructure, or a suburb which is going through gentrification. But if you do buy for equity, then don't forget the investment fundamentals. Don't get so caught up in looking for increasing capital values that you forget that you need to have a property where the rent covers all the costs. Otherwise, that property is going to be taking money out of your pocket. Now, it might sound daft even saying that, but believe me, before the credit crunch during the last boom, people were buying properties that were described as being negatively geared, which meant that the owners, the investors, were having to put money in each month to subsidize these properties, and they were doing that in the hope that there'd be significant capital growth. But of course, when the collapse in prices came, they were then completely caught out because they didn't have any equity and they were subsidizing the property from their own pocket. And you can only do that for so long before you get into real financial trouble. And of course, rising prices is only one way that we can add value, gain equity in the property. We can buy cheaply, what's now known as buying below market value, or we can target properties where we can add value. Most usually this is finding a property which requires repair or renovation or modernisation and improvement, and we'll be looking at this more later. Or alternatively, if you want to build equity, you could even think about putting your properties onto capital repayment loans. Now, the received wisdom within the investing community is that if you're going to buy to let, the best type of finance is interest only. And that's because there are tax advantages, and also because you're only paying the interest, it means there's more cash flow month on month. But there's a vocal minority who will argue that they think that paying down your loan using a capital repayment loan reduces the risk and gives you more security. Now, the truth is that whichever is right for you is going to depend upon what you're trying to achieve, and I can't advise you on that, but whichever you choose should be really guided by the strategy and by your goals. Now, talking about strategy, it's probably a little bit premature, you might think, to start thinking about an exit strategy, but you always want to start with the end in mind. By that I mean you want to structure your property business now and the way that you hold your properties with a view to realizing the best exit whenever that may be. Now, it may be that you don't want to exit for 15, 20, 25 years, or it may be actually you don't want to exit at all. But whatever you think you're going to need to do, you need to start planning for it now, because once you've bought half a dozen properties or more, or once you've got £1 million worth of properties in your portfolio, it's going to be very hard a few years down the line to actually restructure your property business if you're not heading towards the right exit. So it's worth thinking about that now. What I would stress about strategy is that I've noticed that many investors are unclear on which strategy is best for them. And that's another reason why they end up buying properties which are totally unsuitable. The key thing is to have a long-term strategy and to buy with that strategy in mind. There's absolutely no point in recycling your money and assembling a portfolio only to find that the portfolio is full of the wrong type of property. I also would say, as a final point on strategy, that if you want to run different strategies simultaneously, I wouldn't have a problem with that as long as you know exactly why you're doing that. So, for example, many investors want to assemble a portfolio, but most of us have a need for cash. And actually, having a cash reserve for your business is a good thing as well. It's always very healthy for a business to have a cash reserve. So as well as buying and holding for income or buying and holding for equity, you might also want to buy and sell for cash lump sums, which is absolutely fine. Do a bit of flipping and trading on the side. Or it may be that your primary strategy is, for example, creating a passive income. But that doesn't mean that occasionally you might buy a property which is good for equity, even if it's not good for income, and just tuck that into your portfolio as well. But it's obviously going to be down to the individual investor to decide what mix of strategies they want to use. There's a trainer who teaches the 3-2-1 principle, which I was very impressed with. And basically he says, buy 3 properties, keep 2, sell 1. Well, you could adapt that and adopt that strategy for your own needs. So it may be that you could buy 3 properties, have 1 which is income producing, 1 for equity, and 1 for selling for a cash lump sum. Or it may not be 3-2-1, it may be 5-4-3, or whatever is right for you. But all I'm saying is that if you want to run simultaneous strategies, that's absolutely fine, as long as you're clear on what your principal strategy is, and as long as you buy with that long-term aim in mind, so that you buy the right properties. So, when we've decided on our strategy, how do we find the right property for our strategy? Well, if our goal is income, for example, and our strategy is buy and hold for income, then it's implicit that we're going to be looking for high-yielding property, which will produce cash flow. And as a rule of thumb, high-yielding property tends to be cheap property or cheaper property, and so we're now beginning to get an idea of the area that we should be looking in. On the other hand, if our goal is to build equity or wealth, then our strategy is going to be buy and hold for equity, and so it'll be implicit that we're looking for lower-yielding property, and lower-yielding property tends to be higher-value property. And as a rough rule of thumb, we can assume that higher value property is more likely to enjoy greater capital growth over any given period of time than cheaper property. But I do notice that a lot of investors actually lose sight of this, and they might buy cheaper property and then be disappointed about the capital growth. Or they go and buy a nice property which is a bit too expensive, and then they're a little bit concerned that they don't get the income that they want from that property. Now, not every area is right for all strategies. At least that's what we may think at the beginning. In fact, it could actually be true. For example, if you're in an area of very high value properties, it may not be possible to buy properties for yield. And also, if you're in an area of very low value properties, it may not be the most sensible thing to buy properties for capital growth. So we need to be very clear on our strategy and how that relates to areas. But the ideal is to buy within your local area so that you can be in control of the buying process, and if you need to be, on the ground for any management problems. But that's not always going to be possible. So just using a really silly example, I know it's a silly example, but if you lived in Chelsea and you wanted to buy for yield, you're probably not going to buy properties on your doorstep because they're going to be too expensive. You're going to have to buy off your patch. But you'd be surprised how many investors I meet who are determined to make their strategy work in their chosen area. And for example, I come across investors who are desperate to create an income, but they live in an area where the property values are far too high, and they're never going to be able to create the income because the properties don't give the right yield. Despite that, they might spend months and months looking for an ideal high-yielding property, and they stubbornly refuse to change areas. And sometimes you just have to accept that your strategy isn't going to work in that area and move on. But of course, there are always exceptions to the rule. We all know about buying the cheapest house in the best street. And it may be if you do enough groundwork and enough legwork and enough digging around, you may find cheap properties in good areas which are cheap enough to produce the yield you're after. But as a general rule of thumb, if you're after yield, you need to go to the cheap areas, and if you're after capital growth, you need to be heading towards the better areas. But what I suggest you don't do, which is what some investors do, is to sit on the fence and buy properties in what we could consider to be the middle area, which are neither cheap nor expensive, and where they'll benefit neither from a decent yield nor a decent rate of capital growth. And the truth is that if they headed slightly towards the extremes from this middle point, they'd greatly increase the return depending upon their strategy. So don't buy bland properties that's in the middle. If you want yield, make a definite step towards the cheaper property. If you want capital growth, you're more than likely going to be making a definite step towards the more expensive property. But don't sit on the fence. So how do we buy and finance our property? Well, there's many techniques for generating leads to buy properties, all of which can be worth trying and pursuing at one time or another, like leafleting and newspaper adverts and so on. But I'm not going to go into that now, because I want to keep this really simple so that anybody watching this can get themselves up and running. And if you're using this as a refresher course, you can kind of get back to basics and get back to the fundamentals of property investing. Now, I'm always surprised by how many investors seem to turn their noses up about the idea of finding deals through estate agents. But if you think about it, the estate agent has got to be the best place to start. If a vendor wants to sell their property, the chances are they're going to ring an estate agent and get the estate agents round. Probably 90 to 95% of people who are thinking of selling their house are going to start by putting the property on with an estate agent. So in that sense, the estate agents have the low-hanging fruit, and they can give us access to loads of deals. Now, there's a perception that the only good deals to get from an estate agent are the ones that they're hiding in their bottom drawer and which they're reserving for their very best clients. And it's true that when we all know it goes on, that the estate agent will have good deals which they'll be holding back for their preferred clients. But that doesn't matter. We may not be able to get the very best deals out of them, but we'll still be able to find plenty of good deals which are plenty good enough to get us started and to help us to move on. But the trouble is, when we look in the estate agent's window at all those details, those deals aren't marked. It'd be great if the details were marked desperate vendor, buy BMV, buy below market value, make us a stupid offer, all stupid offers accepted. But it's not going to happen. And the only way we're going to find the good deals is by doing the legwork and the groundwork and by digging around and unearthing those deals, which is what we're meant to do as property investors. And the starting point is to know our areas inside out. When we know our areas inside out, when we're very aware of the values and the prices, and when we know the agents, we can see when a property comes onto the market. We'll know whether it looks expensive. We'll know whether it looks cheap. We'll know whether it's worth looking into and perhaps taking further and going around and having a look at and being straight on the phone to the agent. And those are the deals, really, that we're looking for. I'm guessing most people have their alerts set on Rightmove, which is great. But just be aware that not all agents put properties on Rightmove. And not all agents put all their properties on Rightmove. And there's a bit of a time lag between properties actually going into the alert system on Rightmove. And I've been finding more and more recently that I've been ringing up to look at a property that's come through on my alerts on Rightmove, and they're quite often already sold because there's a few days time lag and somebody's already got in there because they're in direct contact with the estate agent. So it's a numbers game. The more properties we go and see, the more we're likely to buy. It's as simple as that. Now, you might be listening to this thinking that's all well and good, but is it really that easy? Well, as a personal example of this, I decided to start investing in what is to me a new patch. And although I'd toyed with the idea for a few months, I resolved a couple of months ago to take the plunge and to start looking seriously on my new patch. So I set aside one Monday to go and visit all of the agents on my new patch and to see if I could find a deal. Now, anybody who knows about estate agents will tell you that Monday is the worst possible day to go and visit an estate agent. You want to go and see them probably on a sort of Wednesday or a Thursday, I think. But Monday is definitely bad. Monday morning is definitely the worst. So it wasn't the greatest time to start this project. But I knew, because I was very, very busy, that if I didn't do it that day, I probably wasn't going to do this for weeks. And I just had to start. I didn't want to procrastinate. I wanted to take some action and get started. And to be honest with you, it was as bad as I imagined it was going to be. The very first agent I went to, I kind of steeled myself and went through the door at sort of 9:15 on a Monday morning, and there were a couple of guys sat at desks at the front of the office playing on their computers, and they didn't look up when I came in, and they obviously didn't really want to deal with me. And I stood there for what seemed like hours, but it was probably only about 30 seconds, waiting for one of them to look up and to acknowledge me. In the meantime, I was sort of hopping from foot to foot thinking, oh, this feels really awkward. But eventually one of them reluctantly said hello, and we went through the usual thing of me saying I'm looking for a property, a 3-bed house in this range, or whatever it was I was saying to introduce myself. And that got my day started. And I went on after that to visit about 12 agents. Now, on that day, I found a deal. So I know that this works. I didn't do anything very clever. There was nothing special in my technique. But what I did do was I took action and I went out and I met 12 agents. And through doing that, I found one deal. So, we've been out, we're looking for our property. What are we going to do now? Well, what we want to do with our property, ideally, is to add value. Now, hopefully, if we've done our research properly, we're going to be buying the property cheap anyway. But for the purposes of this presentation, I'm going to assume that we're going to add value and that the property that we're looking at requires modernization, renovation, repair or improvement, and that by doing some works we can add some value. Now, as I say, it could be that we're just buying a property cheap. The key thing is we're looking to make a margin in the property. We're looking to have some equity, and that could be because we're buying cheap, and there's ways and means of buying cheap, which I won't go into now, but I'm sure we're all familiar with the concept of buying below market value, perhaps looking for a vendor whose main concern is to sell the property, and they're more concerned about the timescale rather than the actual price. But for the purposes of keeping this example simple, we're looking for a property where we can add value through doing some works to the property. Having said that, just to sort of throw it a bit wider, because I know that there's all sorts of opportunities out there that you can come across even when you're not really looking for them. And I came across one the other day where I was offered a pair of flats. Now, this is a pair of flats, sort of a ground floor flat with a first floor flat over, which is in a freehold. It's owned by an investor who owns the freehold of both flats, but both flats have never been sold on to an owner-occupier. They've only ever been rented out. Now, these particular flats, I think I can buy for $70,000, and that's the offer I've made. But I know that if I sold each flat individually, I could probably sell them for about £65,000 each. So after costs, I could easily make around about £50,000. Now, in order to achieve that, I'd have to appoint a solicitor to draw up a lease for each property, each of the flats. We're probably all familiar with the concept that flats are sold on long leases, like 99 years or 125-year or 999-year leases. So I'd get the solicitor to draw the lease up and maybe get somebody to draw a lease plan to go with the leases. And then I'll be able to sell the individual flats to owner-occupiers. And that's what's known as title splitting. Another example of title splitting could be perhaps buying a house and splitting it into two flats and selling the two flats on individually. But it's opportunities like that as well where we can create value. And that's what we're looking to do, to make that margin within the property. Now, going back to our simple example though, if we find a property which requires some work, what we're really looking for is a property that needs cosmetic works. In other words, we're not looking for a property where we might have to apply for building regulations consent and get the building control officer around. If we're getting to that level, then it's the wrong type of property. We don't want major structural works and major works. We're just after cosmetic works, and by that we're probably talking about a new kitchen, a new bathroom, probably a central heating system, which might sound like a big job, but as I always say, it's not a big job for us. The plumber will do that, so central heating's fine. And maybe even new windows, and very likely redecorating. And it's amazing also what a difference putting new carpets in makes. It shouldn't make any difference to the value, but I think because it gives a good feel to the property, it's bound to influence the valuer when they go into the property. So probably also carpets and maybe vertical blinds or curtains, but you don't want to go too far. We're not spending all our money to create the ideal home. We're just putting together a property where we can increase the value and get the property valued up. Now, just to give you an example, the deal which I was referring to earlier, which I found in the estate agents, works out something like this. Now, the property had been on the market at about 80,000. Well, it had been under offer at 80,000. I think it had been on the market for slightly more than that. But for various reasons, the vendor, the purchaser had pulled out, leaving the vendor in a bit of a pickle really, because they thought they had a sale lined up, and suddenly that all just evaporated overnight. So the agent came to me and asked if I'd make an offer, which I did, and I managed to buy the property for £70,000. Now, looking at the property, I couldn't see that there was really very much to do to it. I know that the purchaser who was lined up to buy it before me was going to spend about £30,000 on it. But I think that they must have been an owner-occupier, and I think that they were probably trying to make it into their little palace. But certainly the kitchen looked fine. Certainly if I was going to rent it out, I'd do nothing to the kitchen. The main thing, really, was that the bath was really grotty. I don't know why, because the WC and the pedestal wash-hand basin was fine. The tiling in the bathroom was all fine. It actually looked like a really nice bathroom, apart from this grotty bath, which would have to come out. So a bath would probably cost maybe a couple of £100, and maybe £150 or a couple of £100 to a plumber to fit it. So we're not talking about very much money to do that. And it also needed central heating. So I reckon that would be about £4.5 grand. It needed some decorating, but the wallpaper in it was absolutely fine. And so, although you may raise your eyebrows at this, I'd probably just go in and paint over the wallpaper and give it a fresh coat of paint. And that would be all that was needed. So I was looking at probably around about £6,000 total to do this property. Now I knew from talking to the agents and from doing my own research on net house prices, etc., that probably this property would be worth around about £100,000 once it was done up, once the central heating was in, once it was all cleaned up and redone. So after costs and other fees, maybe even putting carpets in, but certainly there was at least £25,000 worth of value to add to that property. So let's talk about finance. In fact, we're going to talk about finance and refinance. Now, I'm often asked how I managed to start building my portfolio if I had none of my own money. Well, the first thing I did was I went out and I borrowed some money from a relative, and I bought a small house which I refurbished and sold on, and that gave me a bit of cash and a bit of confidence. And the second thing I did was to refinance my own home and to take some equity out. And I was actually starting in quite a bad place. As I said at the very beginning, when I first started, I'd just been made redundant. I had no regular income and no savings, but I was able to withdraw some equity from my own house. Now, some investors ask me, well, that's okay, but would that work today? Surely it was easier then. Well, actually, I think it's probably easier now, because I think most buy-to-let lenders are quite comfortable with the idea of a borrower using equity from their own home or even equity from other buy-to-let properties to use as a deposit on a property. And also, if you read the criteria, the lending criteria, which you can find if you go onto the internet and Google some of the bigger lenders, you'll see that many of them actually don't mind relatives funding a deposit of a buy-to-let property. I know that we used to talk about gifted deposits and that gifted deposits are no longer allowed, but that was in the context of a developer giving a gifted deposit to a buyer. But if you have a relative or somebody close to you who's prepared to pay the deposit on your buy-to-let property, some lenders will actually accept that, just so long as they know that the money has originated within the UK, and as long as they understand the relationship between the person who's paying the deposit for you and yourself. And in fact, some lenders will allow up to 2 parties to contribute that deposit, so that could be quite useful if you're struggling for cash to get started with. Also, different lenders have different criteria, but as I understand it, I should say I'm not a broker and I'm not an IFA, so you need to take your own advice on this, but as I understand it, the Mortgage Works and Birmingham Midshires, for example, don't have a minimum income requirement for buy-to-let. Although they will perhaps just check that you have some kind of an income, even if you're on a relatively low income, that's not going to preclude you necessarily from getting a buy-to-let loan from one of the bigger lenders. And even if you found that your income was so low that you were struggling, many lenders will accept multiple applicants on an application. So, for example, many of them will accept 2 as a matter of course, so you can apply for a buy-to-let loan with somebody else, and it doesn't have to be a spouse, it could be a business partner. Some of them will accept more applicants than that, but you'll need to talk to your broker as to what products are available in the market and who's lending what at the moment, because those terms are constantly changing. So, to build my portfolio, this is what I do. I'd be looking for a property where I could add value, and where I know that I could, in doing the works to the property, add more value than I'm actually spending. And if I can, if it's possible, I'll also be trying to buy that property cheaper than the market value for that property. So, for example, if the property is worth £100,000 in good condition, but because it needed some works, the agent had priced it at £80,000, even if £80,000 was the fair price for that property, I'd still be trying to buy it at 70 or 65, so we're making the margin even bigger on the property. Now, there's two ways, really, that you could finance this. The first way is that you could buy it for cash, you could do the works, you could wait 6 months, and we'd have to wait 6 months because of what they call the 6 months rule, which I won't go into now, but you're probably aware of it. But after 6 months, we'd be able to finance the property. Now, the advantage of that is that there are lenders out there with some quite good loan-to-value rates. For example, the Mortgage Works will offer 80% loan-to-value to an experienced landlord. So if I could refinance onto something with a 75% or even an 80% loan-to-value, then that would be great, because it gives me a much better chance of getting all or more of my money back out of the property when I finance it. And of course, I'd be financing it for the higher value after the works are completed. Now, if I didn't have the money to buy the property for cash in the first place, then I'd definitely be talking to friends and relatives or potential business partners about funding the project for me, because an initial 6-month loan could then be repaid to whoever funds it for you when you draw that loan back out, when you finance the property after that first 6 months. The second way to finance the property, which is perhaps a more interesting way, is to use what's called a light refurbishment loan. Now, light refurbishment loans all but disappeared when the credit crunch came. Let me explain the concept of a light refurbishment loan. Most buy-to-let lenders expect the property to be habitable from day one, and many of them will turn down a standard buy-to-let application even if there's only just very minor works required to a property, because the thinking from the bank's point of view is that they know that you're going to rent the property out and that you're going to be paying the mortgage interest to the bank using that rent, so they want you to be able to rent the property from day one. So I've seen properties turned down for what you could consider very, very petty reasons, but that's just the way that the banks are. But to get around this, because some investors wanted to buy properties where they could add value, some lenders came up with what we would now call a light refurbishment loan. And this is the way that a light refurbishment loan works. And I'll use the example of Paragon, because they currently give a 75% light refurbishment loan. The Mortgage Works have one which has a 70%, Paragon on 75%, and I think there's others like the Saffron Building Society and other smaller lenders who also do a light refurbishment loan. But let's use Paragon because they have a 75% LTV loan. So when you make an offer on the property and you apply for your light refurbishment loan, the bank will send the valuer out who will value the property as at today's date, but they'll also value the property assuming that the works are done, and they'll tell the bank what the likely value of the property is when the works are done. So the bank will then lend you 75% of either the value today or the purchase price, whichever is lower, and they may also at that point, in fact more than likely, they will hold back some money to cover the cost of the works, which is a bit ironic because you have to have the money to do the works, but they actually take it off you. That's banks for you. Then, when you've done the work, the valuer will go back, inspect the property to make sure you've done the works to the right standard, and they'll then confirm that the value that they first thought of all those months ago is still the right value. And assuming that it is, then you'll be able to draw out the balance of the monies, and they'll give you back the monies they've retained to cover the cost of the works. So what that means is, if we can buy a property cheap enough, or if we can buy a property which needs enough work, we can get a 75% mortgage on it today. We can then do the works and then borrow 75% of the end value back out, which means taking out the kind of like the balance between the first mortgage and the second mortgage. And what that means is that we should, if we've done our maths and our sums properly and our research properly, be able to borrow out all of the money that we've put into that property. And the key formula is this: 75% of the end value of the property must equal or exceed the total of the purchase price of the property plus the cost of the works plus legal costs plus the cost of the mortgage application. So if 75% of the end value of the property covers all of our costs, then obviously we can get all of our money back out. And what would we do then? Well, quite simply, we'd go and look for another property, and we'd do the same again. We'd make sure we could buy it cheap enough, or we'd buy it in a condition where we could add enough value, or we'd try and do the two together, where we'd buy a property where we can add value but we'd try and buy it really cheaply, so we've got plenty of margin built in so that we know that we can then borrow all of our money back out. And by being able to do that, we'll be able to buy yet another property, and then we'll be able to do the same again and buy another property. Now, I'm not saying that properties like that are easy to find. The skill of the investor is to find those properties, and that usually comes by doing a lot of hard graft and a lot of research. And it's like panning for gold. But just like panning for gold, if you find a nugget, you don't need too many nuggets before you actually become very wealthy. And that's how it is with property. As I said, we just need to build our portfolio one property at a time. Now, I am sometimes asked, I'm often asked, what if I don't have the money to start with? But I'd bounce that question back by saying, well, what do you have? As opposed to what don't you have? So, have you got any savings? Have you got any ISAs? Have you got any old endowment policies you no longer need? Now, I'm not an IFA, and so I can't advise you what you should do with that type of policy, but what I can do is ask you, how much do you want to do this, and what do you think is going to give you the better return over time? And I've also got to ask, are there any friends or relatives or third parties you know who might want to invest with you, or to be more accurate, lend you the money to go into a project like this? As long as they're getting a good enough rate of interest, then I'm sure there's a lot of people who would be very interested in putting cash into a deal like this. And if you can't find the right deals, or if you can't find the right deals in your own area, then it comes down to persistence. I just said it's like panning for gold. You just got to keep going and keep trying, because you just never know when you wake up in the morning whether you're going to find that deal or not. One day will be the day when you do find that deal, and you only need to go one deal at a time. And if it's not in your area, choose a new area. I'm not saying that you should give up too quickly. You want to make sure that you really can't find properties in your area before you move area. But if it's not working in that area, then do move on. We need to be pragmatic about this. Now, I've had to skip through this really, really quickly, and because I've only got around about an hour for this presentation. But Arsh has very kindly asked me to do a workshop so I can go into a lot more detail on how to do this and how to really make money in buy-to-let. And so I'm holding a one-day workshop on Saturday, the 22nd of March. We'll be registering at 9:30 for a 10 o'clock prompt start and finishing around about 5 to 5:30. And it's going to be in Arsh's office in Wolverhampton. And as I say, this is going to give a lot more time to go into a lot more detail about how to really make money in buy-to-let. And I want to sort of go into a lot more detail of the system so that you can use the system to know with confidence that you can move forward and really start to build your portfolio and your property business and start to achieve your property and your financial goals. And if you sign up now, we've got some great bonuses for you as well. But if you genuinely can't make it on the 22nd of March, or if it's just too hard for you to get to Wolverhampton, then don't go away, because even if you can't make it, I've also got a special offer for you. So just stay with me. So we're going to be covering all the things you need to think about before you buy a property. I'm going to show you how to use your money much more effectively, how to find more money when you need it, how to accelerate your property business, and basically how to achieve all your property goals and your financial goals through property. And so this is definitely for anybody who's thinking about getting into buy-to-let but who hasn't started yet. I can help you get off to the best possible start. It's for anybody who has started but who isn't finding it as easy as they hoped and things aren't going quite as well as they wanted. Let's get back to the basics and let me give you a refresher course. Let's get back on track. Let's get you going again. It's definitely for anybody who's sort of ground to a complete stop. Let's see if we can help you get going again, because there's nothing more frustrating than finding that you've actually ground to a stop. It's for anybody who's doing okay, but who wants to do it better and who wants to really maximize their returns and make sure that they are maximizing their returns. And let's be honest, I'm sure that most of us will probably have a sort of nagging feeling that we could probably do it better. There's usually room for improvement. And it's definitely for anybody who's worried about running out of money before they get to where they want to be financially. As I said at the very beginning, if you want to buy a few buy-to-lets to supplement your pension, or if you want to buy a few buy-to-lets to supplement your income, or if you want to assemble a large portfolio and become financially free, it really doesn't matter. The same principles apply, and this workshop is going to be for you because we're going to be looking at all of that. But who it isn't for is anyone who is already very experienced and who's already achieving all they want to achieve. So if you feel that you're very experienced and you're achieving what you want, then this probably isn't for you. But it is definitely for the 90% of us who probably aren't doing quite as well as we want to. So here's what we're going to cover on the day. I'm going to show you why there's a lot more to successful buy-to-let than just buying a property. I think you know by now that I feel very strongly about this. And we only need to buy 1 or 2 good properties a year to lay the foundations of a really successful portfolio. But I have to ask the question, if buy-to-let is so easy, why are so many people getting it wrong? So please come along and I'll show you how to avoid all the rookie mistakes and even the mistakes that some of the more experienced investors are making. And I'll even show you the biggest and most costly mistake probably 90% of buy-to-let investors make, so that you can avoid it. I'm going to show you the system in detail which I've used to build my portfolio and which will allow you to be financially free in property as well, if that's what you're after. Or you can use it to buy those properties for your pension, or you can buy those properties to supplement your income. Whatever your goal is, this is the system you need to be using. I'm going to show you exactly how I put together my portfolio of 64 buy-to-let properties so that in effect you can copy my plan. There's no point in reinventing the wheel and all that. I've been there and done it. I've made loads of mistakes along the way. I'm not saying any of this to boast, but I have made loads of mistakes along the way. But the thing is that in using this system, I was able to recover and to keep on moving. Well, you've got the opportunity to learn from me, learning from exactly what I did and being able to avoid all those mistakes, so that you can just do all the good bits that work, and you can probably have even better results than I've had. I'm going to show you how it is possible to start with no money of your own, and how you can raise the finance you need. Now, I'm not saying necessarily you can start with no money. There are ways and means of doing property deals with no money, but we're specifically looking at buy-to-let now. But it doesn't necessarily have to be your money. And I'm going to show you what I mean by that and go into a lot more detail about that. And I'm going to show you the 5 power tools all investors should use to exponentially increase their property returns. And I'm not talking about Black & Decker power tools in your refurb. I'm talking about techniques and strategies which you can use to make sure that you're getting the maximum returns from your properties. I know that a lot of investors tend to use 1 or 2 of these, but that's almost by accident. But if you can actually achieve a situation where you buy a property where you can use all 5 of these, then you're going to greatly increase your returns and bring forward that day when you're getting that passive income or that equity that you're after. And I'm going to go into a lot more detail on the magic formula that we've been looking at, which will allow you to buy as many properties as you want. So, going to be able to go into a lot more detail. And ultimately help you to achieve your financial goals through buy-to-let and show you how you can achieve your financial freedom if that's what you want. So how would you value this information? What value would you put on finding those few properties to supplement your pension? What value would you put on finding those few properties to supplement your income? And what value would you put on assembling a portfolio that allows you to be financially free? Well, a one-day workshop like this would usually cost at least £497. But Arsh has asked me to do a great deal. He's been twisting my arm, as you'd expect. And so for that Saturday, 22nd of March, it's going to be just £297. Plus, I'm going to throw in some really nice bonuses for you. If you book now, bonus number 1 is I'm going to give you a copy of one of my best-selling ebooks, Goals to Property Success in 5 Simple Steps, which will show you how to set your goals in property, how to make them into financial goals, and how you can make an action plan to achieve those goals. And that's obviously a key thing that we've been looking at tonight, and that sort of runs parallel to the course. But really nice surprise bonus number 2 is that Arsh has really kindly agreed to give you a copy of a USB memory stick packed with vital information which he's put on it, which he normally charges £197 for. I've seen him selling these at some of his seminars, and he genuinely sells these for £197, and that's packed with loads of documents and information which is essential to a landlord, like tenancy agreements and certificates and all kinds of other stuff, which he's agreed to put in as a special bonus. You'll see here's some of the documents that he's included: guarantor documents, templates of sales schedules, of housing benefit letters, of rent statements, guarantor documents, housing benefit accountability spreadsheets, all kinds of really good stuff on there for that USB, normally £197. Now, I did say if you really can't make the workshop on Saturday the 22nd, then that's a shame. We'd love to have seen you, but don't worry. What I've agreed to do, Arsh has asked me to do this, is to put together all the course notes as a workbook. And I'm going to throw in a lot more information as well. Some nice little goodies will appear in that as well. But basically, you can have all the information which I'm going to be delivering at the workshop in the form of a workbook, so that you can work through it at home, review it at home, and so you can start using all these techniques and strategies to start building your portfolio, even if you can't be there. And if you click on the link which Arsh is going to send you, you can have that for just £197. But if you can make the workshop on Saturday the 22nd of March, I'd love to meet you. Be there for 9:30. We'll have a prompt start at 10, and I'll spend the day teaching you loads of what I've learned over the last 30 years as a chartered surveyor, as an investor in property, as an investor investing for myself, and as a chartered surveyor advising other people, so that you can start to achieve your buy-to-let goals. So, if you want to come on the 22nd of March, go to Arsh's website, www.arshalahi.com, click on the events tab, click on the 22nd of March, click buy now, and reserve your place. But alternatively, if you can't make it, then Arsh will be sending out a link, or you can email me, or you can email Arsh and say that you want the resource pack, and we'll send you everything that I'm going to be teaching that day as a workbook, along with the bonus, the ebook, which will show you how to set your goals and to make an action plan so you can achieve your goals, plus the USB memory stick, which Arsh usually charges £197 for. And that can all be yours for just £197. Anyway, thank you ever so much for listening to me, and here's to property success.